There was a Nobel Prize in 2013, and it was awarded to Fama for the efficient markets theory. In the same year, they awarded the Nobel Prize to Schiller for basically saying that the markets are irrational. So in 1 year, they awarded the Nobel Prize to two different views and perspectives, right? The market is efficient, the market is irrational. How can it be both of those things at the same time is a good question that you might want to ask yourself.
If I had to think about that, I would say most of the time it is efficient until it's irrational.
That's a good framing of it.
Thank you. I just came up with that. From an operational perspective, just in the day-to-day, it's going to be extremely efficient. And because it's traded by algorithms and because the market capitalization of these companies have grown and the amount of trades being placed, there are so many more data sets now that would make it efficient. But in the event of something like a black swan or a news article that came out or something that was out of left field, then it's becomes irrational. So it's just like the way that I think about it is a car is driving down the road. Everything's predictable, nothing going wrong, but then a tire blows out. And then, what happens at that point? Or there's debris in the road, it's never going to be absolutely perfect. And that's the way that I look at the market is it's probably efficient most of the time until it's not.
Welcome to the Compound Growth Podcast with Colin and Wheeler, where we talk all things growth. From financial growth to career growth, personal development to societal progress, we explore how each layer builds on the next, compounding over time to shape who we become. Each week, we break down complex ideas and emerging trends into clear, actionable insights. Because growth isn't just about numbers. It's about understanding the world and our place in it.
I'm very low energy today. You might need to carry the show, Colin.
Why? What's up with Stoneface?
So this is actually part of why I'm low energy. It's not because I had 3 Hold Steady shows over the weekend and they almost killed me, because they did almost kill me. But it's because I did that Everlywell study, the thing where you do the blood work.
Yeah.
So I did a food sensitivity test. They have a bunch of different blood tests that you can check, like, for thyroid or
the
just
whole thing,
whatever. So I did one for food sensitivity, and surprisingly, the food I am most sensitive to is kale.
Out of all the things to give up, that might be the easiest.
No, you would think so, but it's like in my smoothie 3 or 4 times a week.
Really?
And then when we go to Stoneface, we get the kale Caesar salad.
Huh.
So I'm sad about that, but it's manageable. To your point, like of all the things to give up.
Yeah.
Like
what if it was dairy?
Well, further down the list is dairy. And dairy, it's like some of the individual components are things I have to be aware of. But in general, dairy as like a category had the most components that I'm sensitive to. So my smoothie, which has like yogurt, kale yogurt, lactate, which is like I'm being smart and I don't have the lactose. No, but it's the proteins in the dairy.
See, I thought you were going to tell me this restaurant wronged you in some way.
No.
And I was worried about it.
My body is wronging me, is what's happening. Whey has been my protein that I've been using.
I had to switch from whey. See, I worry if I do this, they're going to mail me a scroll
of all the things
that I'm going to release, and it's just going to fall and roll all the way across the floor and down the hallway of all
No,
the
it's
things.
a digital scroll. It's a scrolling on your phone. They're tech forward. Here's the biggest issue for me.
I would have preferred a printed scroll, to be honest.
So in addition to kale and just dairy as a category, there were things are easy for me to, like octopus. I'm not going to. No fish oils. Oh yeah,
octopus.
It tested a lot of different raisins. Not good for me. You can't do raisins. And these are not they're not even intolerances. They just have different inflammations and the way that you impacts your energy, etc. Coffee, great for me. I'm totally good with coffee. Here's the hardest one: sweet corn. So
how was that hard?
So originally that was my take on this. Okay, well, I just won't get the cans of sweet corn or sweet corn on the cob or whatever. No. Here's where the hidden sources of sweet corn.
Oh no!
So hidden sources are in.
Is it canola oils?
It's tortillas.
Yeah.
cornmeal, cornbread, cereals, corn flour, tamales, polenta, cornflakes, corn starch, corn syrup, high fructose corn syrup, corn oil, dextrins, maltodextrins,
So that's
fructose,
basically everything.
ethanol, sorbitol.
Like it just keeps going.
Dude, it's so bad.
That sucks.
And I'm like, wait. So they recommend an elimination diet. Like, and it's like a 3-week eliminate, like cut it out and then start to work things back in after 3 or 4 weeks or whatever. But I'm like, if I were to eliminate kale, sweet corn, and dairy, raw chicken, I'm just going to eat like straight chicken all the time. Water, coffee. I can do coffee.
Yeah, that's true.
So I'm in a space because I have all this data and now I have to do something with the data. And I'm wearing my Whoop again so I can track
noticed that.
it.
I was going to ask you about it.
I'm handcuffed to my data again. Here I am, back where I started.
You know, you were the one that told me I needed to get a Whoop or an Apple Watch for a long time.
Well, it's useful.
Then you get off of it, and now you're back on it again.
Are you saying it's a roller coaster?
It is a roller coaster.
In this relationship?
I have decided that I just don't care about my health anymore.
Given up?
Yep.
Just altogether.
I've given up. I don't care.
It's like you when you went bald, you're like, ah.
But I just feel as if at this point in my life, if I just eat relatively healthy, you know, I've like done all these different workout plans and cutting things out. And I realize like I'll drop 10 pounds and then I'm like, my life sucks. And then it just comes right back. But I'm always like, I do believe in set points for weight in general.
Like there's like a fixed place that's your normal.
There's a fixed place that your body has just become accustomed to.
Yeah.
And I just feel as if my body over the last, like my weight has hardly changed in 15 plus years. You know, no matter like if I work out every single day for 5 months, it's still relatively the same. It fluctuates by 3 or 4 pounds, which is a relatively small percentage amount in regards to my size. But yeah, I mean, at the end of the day, I'm just going to continue to do whatever it is I'm doing because while my BMI says it's terrible as a man, it's so messed. Like
BMI is a horrible.
It's a horrible metric.
Yeah. Yeah.
So
I'm not trying to lose weight though.
No, I know you're not.
What it is, like I wouldn't mind if as a byproduct, I like all of a sudden.
Yeah, I would not complain. Yeah.
But I'm just trying to figure out like what healthy looks like. Right. And so I'm getting all this data and I'm like figuring out what to do with it. And then I use those, like that information to make my decisions.
Makes sense.
Much like you do as an investor when you're looking at the stock market and all the different data points that go into the stock market to inform the direction of where your investments are going.
Yeah, that's true. That was a rough one.
Transition. No, come on.
That was a good one.
No, he said that's a rough one. No.
It was a rough one. It was a rough one, meaning I think it was a stretch, but we got there.
I'm just saying it's all data.
It is all data. And that's what we're talking about today is I don't want to say the data that goes into the market, but we had an interesting question that came from a listener that I think spurred this whole thing that popped up, which is a comparison between AI, which is a machine learning kind of model, versus the market and the different data points that go in and how they're kind of correlated.
Let's read the quote.
In a way.
Let's read the actual.
You were talking about the market as an entity. It occurred to me that you were talking about the market as though it is some type of AI. Compiled collective knowledge, spitting out measurable data.
And I just want to point out that this topic was not our idea. It was Tori's idea. And she is sorry, Tori. You brought the AI into this one. This is not us.
Yes, that's true. This is the first time we did not bring up AI on our own.
I think the point that our listener was trying to make is that, especially as an advisor, I feel like we talk about the market as its own entity. And there are certainly some similarities that we can unpack regarding kind of the collective intelligence that the market represents and how you can find some similarities to that collective intelligence in AI, right? They're both basically sources of collective intelligence. They have all of these different data points that they refer to and assess and then move forward.
Right. Yeah, exactly. And I'll say, well, I don't want to get too far ahead, but there are a decent amount of similarities in the sense that it is a massive amount of data that's being collected and analyzed, whether it's through algorithms or machine learning or whatever it might be, to give you a specific outcome or result or a target. And that's what we're diving into.
Yeah, but this is not a new concept. So like
No.
the concept of Mr. Market, so that was popularized by Ben Graham, right? And he thought of the market as basically an irrational business partner, right? It's basically you come into your office every day and you are trading with the market. It's in connection to the market, and the market is, basically off its meds from day to day and just making some irrational things happening, et cetera. And so I think it helped him to frame the space within which he was working as like an entity. It's like, well, Mr. Market's doing this today. What am I going to do about it?
Right. Yeah. The thing with Ben Graham, and for those of you that don't know, wrote The Intelligent Investor and kind of the father of behavioral finance in a lot of ways.
Value investing
for sure. But the market was also a very different place when he was writing the book back in the day. And if you were to even go back further than that, I think in the Great Depression, only 2% of the American populace actually owned stocks.
Very close to that number.
Yeah, it was very, very low versus now we have, I think, close to 56% of the U.S. populace owns stocks in one way, shape, or form, whether it's through 401ks, IRAs, or brokerage accounts, or whatever it might be. So the market has changed a lot since then, but he was the one that originally coined that thought.
Yeah. And I think what's changed the most about the market at that time is that all the data points that you mentioned are originally like the algos or machine learning or whatever. Those are the modern data points. And what he was referring to was the market is just like a collection of trades being placed. And those trades were always being placed by individuals.
Yeah,
right?
Exactly.
It's basically crowdsourcing on some level. What do we think this investment is worth as a crowd? And it's worth pointing out that for every buy, there's a sell and vice versa. You don't just like buy or sell into the ether, right?
Yeah. And that's what makes the market goes up, right? Like if you look at Intel as an example, we were just talking about that in a recent episode. The reason why that went up is because there were a ton of trades placed that drove the price up.
Right.
It doesn't just go up randomly. There is a reason and a purpose behind what's actually driving it up. And it's just like supply and demand.
Exactly.
Buying, the stock price goes up. When people are selling, it goes down.
Yeah. Everybody wants Intel. Nobody wants JetBlue.
No, they do not.
And then you have.
With that being said, I did just buy JetBlue plane tickets last night.
Well, you got to use those points.
I know. I got to use them before they go bankrupt.
I have on good authority from one of our clients who just has determined that they're going bankrupt. I don't know.
That is not insider knowledge, by the way.
But I think what's interesting to me is you have kind of like that push-pull. It's the idea that if the market is the Ben Graham Mr. Market, then it's very inefficient and you can find different ways to make money, right?
Profit.
In relation to the market. Now we have all these algos and machine learning, et cetera. It would suggest that the market is efficient, right? Like it doesn't matter what you do. The market is the market. Everything reverses to the mean, and then you can't outsmart the market. There was a Nobel Prize in 2013, and it was awarded to Fama for the efficient markets theory. In the same year, they awarded the Nobel Prize to Schiller for basically saying that the markets are irrational. So in 1 year, they awarded the Nobel Prize to two different, I think they were mathematicians, but two different views and perspectives, right? The market is efficient, the market is irrational. How can it be both of those things at the same time? Is a good question that you might want to ask yourself.
If I had to think about that, I would say most of the time it is efficient until it's irrational.
That's a good framing of it.
Thank you. I just came up with that. I think from an operational perspective, just in the day-to-day, it's going to be extremely efficient. And because it's traded by algorithms and because the market capitalization of these companies have grown and the amount of trades being placed, there are so many more data sets now that would make it efficient. But in the event of something like a black swan or a news article that came out or something that was out of left field, then it's becomes irrational. So it's just like the way that I think about it is a car is driving down the road. Everything's predictable, nothing going wrong, but then a tire blows out. And then, what happens at that point? Or there's debris in the road, it's never going to be absolutely perfect. And that's the way that I look at the market is it's probably efficient most of the time until it's not.
I'm going to take a unplanned detour here.
Okay.
So I spent some time in Boston over the weekend, Boston and the surrounding, Cambridge, Somerville, etc. And I'm not driving around the city so much as I used to, right? Driving around here, it's much more, it's easier to get an autopilot to a degree, right?
Yep.
Like there are fewer interruptions to your progression. But when you're driving around Boston, there are many, many interruptions.
Especially Boston.
Right? But there are jaywalking pedestrians and masshole drivers and just like all of these different like stop go opportunities, right? So we were driving through Somerville yesterday, and we were trying to find this tiny museum, I guess is the right way. I think it's like a small Smithsonian or something, like tiny Smithsonian. It's like this woman built this little thing outside her house, and you wouldn't know about it unless there might be a Yelp page for it. I'm not sure. Found out about it in a book, and she said, like, let's go check it out. And so we were driving there, we're approaching the destination, and I have my GPS saying, here's the destination, and here's the left turn I need to take. And here's this woman getting out of her car on my right hand side, right in front of me. I'm paying attention to that. And Jess says, watch out. I'm like, all right, I see her. And she's like, stop. I'm like, I don't think I need to stop because I can see her. But what Jess was seeing was on the other side of the woman in the car were two people waiting to cross at the crosswalk, which I wasn't paying attention to because I was paying attention to the 3 or 4 other things happening at the same time.
Sure.
So Jess had a different point of view. Mm-hmm. And she said, from her point of view, watch out. Yeah. And from my point of view, I saw something to watch out for, and I watched out for it, right? But there are two people basically next to each other looking at the same scenario and seeing different things and reacting very differently to those things.
Right.
And what I found interesting about that, and I'm bringing it back to the market situation, is that's regularly what happens with the market as a whole, or as these individual stocks, et cetera. You look at something, you interpret the data, and then you say, well, I think this. And somebody else says, well, I think that. And then you're opposite side of the trades, right? So I feel like we're constantly trying to tune out the noise and curate the information and tell our clients how we see things from our perspective. But all we're doing is perspective providing.
Yeah. Well, I think you just called on, in my opinion, the biggest difference between what like an AI model is versus what the market actually does.
Yeah.
And if you think about AI as a whole, it's very centralized, meaning that whatever your flavor of the month is, whether it's ChatGPT or Claude or Grok or whatever it might be, you're going to have an AI learning model that is going to be a machine-based learning model. And the whole point of this thing is to collect as much data as humanly possible to basically predict, using machine learning, what the next best outcome is. So like, as an example, if you start a sentence, what it will do is kind of predict the end of that sentence using like the highest probability of what typically comes next. So it's learning, but it doesn't necessarily have a motive per se. Versus if you think about the market, yes, it is similar in the sense that there are a million different data points and sets going in, but there's no centralized core to it. You have hundreds and thousands of decentralized theories trying to maximize profit at the same time. So you have hedge funds, you have quants, you have institutions, you have people like you and me, you have individual, clients that are trying to buy and sell on a day-to-day basis.
Advisors and then clients that are trading on their own.
Correct. Yeah. So the thing is while AI is learning because it's a centralized model and it's constantly building the algorithm, in the market, you have everybody competing against each other. And the thing is while AI is constantly building and getting better, the flip side of that on the market, which is kind of interesting, is if, let's just say you have a hedge fund that has some sort of strategy and it does super well because it finds a niche, money is going to flood in. And then at that point, they're going to lose their advantage because it's basically going to homogenize it with the rest of the market.
The market's learned what it knew. Yeah.
Right. Exactly. So it gets absorbed. Yeah. So it's just like what we were saying earlier. It's efficient until it's not. And then once it's not efficient, it reverts back to the mean.
So let's assume then that your point of this is it's like an amalgamation, right? Like it's this immersive phalanx that is just continuing to grow and learn, and it does that on repeat, right? Yeah. I think of that as in our prep when Tori did some of our production prep for us, which is always very helpful. Some of the prep suggested that we should think of hallucinations, AI hallucinations, as essentially a direct connection to when there's a bubble in the market, right? The market thinks that there's something up like this, blah, blah, blah. And that's like hallucinating value. I think that the market, I don't think that the market ever hallucinates anything, but it can have those irrational moments like this, the SaaSpocalypse earlier this year.
Yeah.
Right. So we have, Claude come out with all these, or Anthropic come out with all these different utilizations for their technology, and all the software stocks go to, get cut in half. And that to me is an overreaction. The market will frequently overreact to things, and then it adjusts and moves forward. So to your point, it's, rational until it's not.
Yeah. Well, it's like when First Republic Bank, was another example fairly recently,
Totally.
Where that went under, and then basically all the other bank stocks, people were
Silicon Valley Bank was,
Silicon Valley Bank.
Yeah. So if it's, and maybe it's my lack of familiarity with hallucinations and how AI reacts to hallucinations, but does AI learn from hallucinations? Is that appropriate to suggest?
I think it's fairly appropriate, assuming there's enough data points to it. Like it's going to basically, from what I understand, take all the data from maybe all of the hallucinations that it has access to, and then compile that into what it thinks what a reasonable output would be.
Right. So I think it's what you brought up a point earlier that, at the turn of the century and into the Great Depression, it was less than 5%. It was a small amount of Americans that had stocks, right? And now we have the majority on whatever level of Americans who are invested in the stock market at some point, right? And we've had all these different gyrations along the way. We did have that depression. We've had, the Nifty 50. We had stagflation. We had the crash in 87. We had
dot-com bubble.
Yeah, the dot-com bubble, et cetera. We had the GFC and COVID. And like all of these little things, or some of them are pretty big things, are learning opportunities for the market, I think. And what I appreciate about the market isn't that it's always right, because it's not always right.
No, of course.
But it's always forward thinking. So it's always pricing in overall the collective understanding of what something's going to be worth in the end.
Yeah.
Right. But it doesn't mean that it has to be right. But the truth is, overall, it grows. And it grows not just in terms of increasing value, but it grows in terms of its ability to understand what's happening. We help it grow. We create breakers, right? So that the stock market goes down too fast, it just shuts off temporarily.
Right.
We do these things to like, well, in this type of situation, we know what the political playbook is to support the country if there's like a GFC type situation, right?
Yeah.
Or COVID, whatever.
Yeah. I was having a conversation with a client the other day about this, and they were I was talking about portfolios. And, I was like, do you want to be more growth oriented, or do you want to be more conservative? And, she was like, I don't really want to be more growth oriented because I don't want to lose my money. I think that is a fear that a lot of people have when they hear the word growth or risk. But the purpose of the market versus what AI is doing, AI is trying to basically make something that's as efficient as possible and as accurate as possible. The purpose of the market is to drive revenue and growth. Like people are trying to profit here. So that is the purpose of this. And for someone to invest their money in, let's just say, an index fund, and for all 500 of those companies within the S&P 500 to go bankrupt at the exact same time,
is unrealistic.
Yeah. And there are quotes out there, it's not what you don't know that gets you into trouble. It's what you think you know for sure that you're wrong about that gets you into trouble. Mark Twain. And with the market is extremely efficient. That is true. But there are always black swan events that pop up, like the great financial crisis, or whether it's the dot-com bubble or COVID, X, Y, and Z. But then that becomes another data set. And then once we have that, we can then learn from it and then implement. So in the long term, the market will become more profitable and predictable because we have more data points.
Yeah. I think what happens in a scenario like the GFC, the black swan event essentially is the housing market, right? And all the leverage that is underneath the housing market.
Yeah.
And the issue is that if the market acts on collective information, not enough people have that collective information. Some
Totally.
people did, and they made a lot of money, right? But it's all about getting all the information. And I think it's not that the market said, well, I guess stocks are worth 45%, 54%, whatever it might be, less, this year than they were last year. It's that the market says, well, I think everything's worth a little bit less, and everybody else overreacts and says it's worth way less. Let's just sell everything, right?
Yeah.
And that's when you have the human behavior part of it. And I think maybe the way to think about this is actually the directional aspect of it. It's not that the market is right to go down by 20% or up by 20%. It's that the market is directionally looking in the right direction, right? It's just moving the way that things should be moving. And then we, as investors, amplify that in one way or the other.
This reminds me of 2022, when interest rates started to go up. And then there was that year where no matter what you did, you pretty much lost money because fixed income was going down dramatically and stocks went down too. There was war in Ukraine and a bunch of other stuff. But bonds were super frustrating.
Yeah.
Because we all know through basic economics classes, and those of you who don't know, it's when interest rates go up, the value of your bonds tend to go down. And if you think about it, it makes perfect sense, right? If you're a bank and if you give out a mortgage at 3% interest, let's just say, everybody's going to want to have a 3% mortgage.
Mm-hmm.
However, when interest rates go up, that means that people can no longer get that 3% mortgage. So people will pay more for your 3% mortgage. It makes it more desirable if you can no longer get it. On the flip side, if mortgages go down, so let's just say they were 3%, now they're at 2%, that makes your mortgage less valuable because you'll refinance it to go down to the 2%. So there's an inverse relationship between interest rates and the value and price, the value of bonds. So we had a situation where interest rates were going up and the value of bonds were going down, but people were panicking about it. And they were also pulling all of their money out at the exact same time from fixed income, which was driving the value down further. So to your point, it was directionally accurate that when interest rates went up, the value of the bonds went down, but they went down way more than what anyone anticipated at the time.
Well, there's also, and we've talked about this a little bit, when you have the shorter duration bonds, the ones that are like 1 to 3 years or less, right? They're going to be less they don't fluctuate as much in value because they don't have that additional driver, right? They don't have that investor force that's really moving the value of those bonds. When you think about treasuries, people are betting essentially on what the interest rates will be in the United States 10, 15, 20 years from now.
Right.
And that's really unpredictable. When you have kind of a trajectory where directionally interest rates are going up, people carry that too far. And then you see the bond values that are further out on that curve, on the yield curve, go down more because they have that price dependence that you were talking about.
Yeah, exactly. So to your point, I mean, directionally accurate is the best way to think about it.
Yeah.
If some news comes out about tech and AI is taking over or whatever, or software is having a rough time and Apple stock drops 20%, that doesn't mean that it was justified necessarily to drop 20%, but just that sector in general.
Yeah.
Because of it.
I heard an interesting fact today. And this is actually, it's very logical. It just makes it's common sense if you really think about it. But the turn of the century, we had the internet kind of coming to fruition in the business world, right? Like it's, the internet is here. It's going to disrupt everything. All these brick and mortar stores are going to go out of business because you can buy everything online. Amazon will destroy the world.
Sure.
Right. If you look at the top e-commerce websites, top e-commerce businesses, right? Because it's whatever, some of it's not done on a computer. But e-commerce, as businesses by volume, what businesses have the highest volume, do you think?
Do you mean like Amazon?
Yeah, sure. Like Amazon. What are like the top 5 largest e-commerce volume business you would think
that I could think of? It would probably be Amazon, maybe Walmart.
Yep,
would be on there.
Yep.
I don't want to say Home Depot, but
but Walmart's on there.
Yeah.
So did Amazon came in, was a massive risk to Walmart. Best Buy's on there.
I get a lot on Best Buy, but I thought that was just me.
But no, it's Best Buy's though. But Best Buy, Walmart, brick and mortar stores, they have a ton of e-commerce volume, right? So did Amazon. where everybody was going to buy things online, come out and destroy Walmart? No, right? Walmart just adapted to become more like Amazon. There's a company out there called Fastenal, and Fastenal sells nuts and bolts, literally nuts and bolts. And they will basically, any large scale job site will have Fastenal like suppliers essentially there. And you can they'll have vending machines. It's like you need 20 whatever size bolts, you go to the Fastenal vending machine type of thing. So when Fastenal is a company that's been around for a long time, tech bubble era, Amazon comes out, everybody says Amazon's going to destroy Fastenal, right? Fastenal is up like 400, 500%. It's massively improved the size of their business. It's still here. It's still a very strong business, even though Amazon came out. Amazon didn't just destroy everything that could be sold anywhere. Other businesses had to adapt, or Amazon had to choose, do we want to be in the nuts and bolts business? It's just like healthcare. Like Amazon was supposed to destroy all the healthcare companies because they got into the healthcare space, but that's not what happens. Why is Anthropic any different?
It's not. I have been a very firm believer that I don't necessarily think that AI in general is going to destroy a lot of businesses. I think it's going to improve a lot of business. And that's personally my own opinion. You want to know what this brought me back to is we had the SpaceX, episode that we did the other day.
Yeah.
And I was watching TV last night and there was a T-Mobile commercial. And T-Mobile was talking about how, we're going to roll out satellite and all these kinds of other things for businesses. And we have all of this business benefits that you can tap into in regards to high-speed internet. And then at the end, it said, brought to you by... Do you know what I'm going to say?
No, go ahead.
Starlink.
Starlink.
Brought to you by Starlink.
Interesting. T-Mobile brought to you by Starlink. Okay.
Yeah. So I thought that was very fascinating that once again, I don't think Starlink is going to replace these businesses, but T-Mobile is now using Starlink satellites to provide business internet.
Well, the best businesses are B2B, right?
Yeah,
it's because business people like doing business with other businesses. It's like, it's such an easier, like we're not in a B2B business.
No, I know.
But
yeah.
Fastenal, I misspoke. They're not up 400 or 500%. They're up 2,400%. So Amazon did not kill Fastenal. And there will be other companies that got mixed up in the SaaSpocalypse that will not be killed by Claude or Grok or whatever.
Totally.
But there will be some that don't survive, right?
Yeah, definitely.
Those businesses will be disrupted.
Well, look at like Sears, Macy's,
Sure.
like all of those brick and mortar companies that are now being replaced by the bigger presences online, like the Arlo's or Lululemons or all of those types of companies that people are now trying to go to online. Wayfair,
Yeah. But I think those are just companies that didn't adapt.
Yeah, exactly.
Right?
Adapt or die.
Yeah,
it's Blockbuster.
Exactly. It's Blockbuster. It's always Blockbuster.
It is always Blockbuster.
But that's what I think the directional aspect comes from. Directionally, there should be a reassessment of the value of all of these software as service stocks. I get that 100%. But that doesn't mean that all of these management teams that we all thought were like really well-run management teams are just stupid all of a sudden. It means that they're probably doing something too. If they recognize the threat, they can adjust to the threat. And so I think that is it's the compound growth effect of learning, right?
Yeah.
The stock market is always compounding and growing. And I think in that relation or in that aspect, it is similar to AI. It's funny because I might take this narrative now. I might like help explain the market to somebody. I might like say it's similar to AI and it's not our idea, but I like it.
Right. Yeah, it is pretty good. But also AI and threats to the market in certain industries is nothing new.
Yeah.
I mean, we've been through this a million times, not with AI. And I recognize that every time it's different.
Yeah, sure.
And there have been a ton of threats to our own industry in regards to new rulings that have come out. The internet come out, going even further back, you had the assembly line in manufacturing and all these other things that change the way businesses operate. So there's a million things that will inevitably come up over the next 100 years that we can't even anticipate that will be threats to some businesses, but will pave the way for others.
And I think the expectation, and it's maybe the market is innocent until proven guilty in this manner, but I think the underlying truth is that the market will digest and absorb and continue higher. It will go down. It always goes down at some point, and then it goes back up. And that's been a tale as old as time when it comes to investing in the US stock market. And the market now, as it grows and compounds on itself, it just becomes a better version of what it was before. So the question then is, if the market is similar to AI in that way, what if AI was investing for you in the market? Like, what if you kind of like hot glue these two things together? What is the outcome?
To be honest, I feel like I know the answer to this.
Okay, you already know.
Yeah, I already know.
Uh-oh.
Okay,
Now I'm not sure.
So we started in the beginning of this saying that what AI is it is a collection of data, and then it uses that to predict the most likely outcome.
Yeah.
Right? So if that's the case using machine learning, then it will look at the stock market and say, what is the majority of people doing? And then I'm going to use that to predict what most likely you're going to be doing. I doubt that I doubt that AI is going to look at the market and say, you need 3 hedge funds, 4 alts, and then this random mutual fund over here.
Right.
It's going to be doing what collectively the majority of people are doing to get to a desired outcome, which would be indexing.
Yeah.
Because that's what it would do. It wouldn't do anything that's necessarily crazy or different, because if it was to do something that's crazy or different, then that technically wouldn't be a machine learning model. That would be an algorithm built by a completely separate source.
I wonder if that would then smooth out the volatility or heighten the volatility.
I think it would concentrate it. But you could argue the same thing with passive investing right now.
Yeah, I mean, theoretically, what really underlies and kind of props up the value of the market is that everybody who is averaging into it,
it's consistent purchasing
consistently through passive investments, right? It's just, it doesn't really matter. They're not picking NVIDIA versus Intel. They're basically just saying, I want both.
Yeah.
And, I'll let the market decide.
Yeah, exactly.
And there's definitely value to that. I think over the long run, like when I was thinking about my daughter's Roth IRA today,
Okay.
and I was like, I believe in owning stocks, individual stocks, for a long periods of time, longer than the average hold period is like 5 months for an individual stock. Now.
Really?
Yeah. 5.5.
That's actually shocking to me.
It's not great.
No.
Because people are trading more than they're investing. And I prefer the investing side of things. But when I think about the time horizon for my daughter's Roth IRA, it's going to be another 50 years before she uses it. Am I sure that I know what stocks she should hold for 50 years? Probably not. I'm not that deep in my time horizon. More like, well, I can be more certain that the stock market will be up overall in 50 years than Apple or NVIDIA or whatever.
Yeah, that's the tricky part.
Yeah.
With the further you take out the time horizon, the more unpredictable it becomes.
Yeah. And I guess you could diversify. You could have the idea. There's this book that just came out called The Coffee Can Investor. And the concept is they used to actually have stock certificates that people would have when they bought the stocks. But you could take, in the 90s, you'd have stock certificates, and maybe you have Apple and Xerox and Microsoft and Nike,
Disney,
whatever. And you just stuff them in a coffee can. And then 50 years later, you take them out. And what are they worth? Right? It's not quite 50 years later, but yeah.
I know what you mean.
And some of those, Apple and Microsoft, great. Xerox, not so good. And Nike was good until 5 or 6 years ago.
Yeah.
But I guess like diversification being the key there, like, the winners, we were talking about going long the market and short the market the other day. And you pointed out that you can't lose as much as you stand to gain, right? You can lose 100%. You stand to make much more than that.
Yes.
And if you hit on like 2 or 3 out of 10, that can offset the others and then some.
Yeah.
In the long run. But I don't know.
Yeah.
What if you miss on all 10?
I love, well, Ben Graham, I think it was 22 stocks.
Yeah. I mean, the perfect portfolio
was 22.
22.
Yeah. It was somewhere around there was the perfect portfolio with 22 randomly selected stocks in theory.
Well, not random.
Yeah. You have to have certain sectors.
You have to have some analysis, but you cover a lot of
you cover the sectors,
variety.
but you are in theory diversified at that point with 22 stocks. Whether or not that still holds true, it's been a while since I've looked at it. I'm not 100% positive, but the problem becomes once again time horizon. And you can argue that, maybe those companies wouldn't go under, they would get acquired, so you get shares of something else or whatever might happen. But for someone like Michaela that has a 50-year time horizon, indexing is certainly the easy button. And that, in my opinion, is what pretty much every AI would do for you at that point. So then the question becomes is it really that much of a benefit to AI managing your money at all?
Yeah. I mean, the risks would be like hallucinating, I guess. Like,
Yeah.
It's funny. I think that, when Bitcoin became more publicly adopted, right? When it became something that you could buy ETFs for, and when it became something that the administration was championing,
it immediately lost its cool.
It's like now you can't make, I mean, people are still investing in Bitcoin and maybe they'll make a lot of money, and I can't predict it, but it's definitely changed the dynamics underneath, right?
It's made it very efficient.
Yeah, it has certainly made it. You don't have the same volatility in Bitcoin that you used to have. And it's because of I guess, as it graduated and grew into what it is now, it lost the ability to be as volatile.
It's kind of like when I graduated from college.
Okay.
I was going out, I was having a great time. Things were really fun, but as I get older, I'm in bed at 7:45, kind of have the same routine every day for the most part. In no way is this a complaint. I love my routine. But like when it comes to a stock or something like that, in the beginning, it's very exciting and unpredictable. You never know what's going to happen, which direction it's going to go, what legislation is going to come in and change it. But once it's been around for a long time, and as, big money comes into it, as, legislation comes into it, it makes it more efficient, which means that there's less opportunity there in theory for an adverse return.
Yeah. I would certainly think that AI, to your point, I think that AI would make things more efficient, and it would become maybe a more efficient market that could then become irrational in a very special way.
Yeah.
Because all the things that are built into the market are still there, like the breakers are still there, et cetera. But if you have AI making your investment choices and it thinks something is coming and it's wrong, then it could become very irrational. And AI is not one by one by one by one. It's like the same AI for everybody. It's like a contagion aspect.
What's kind of funny about this, we were talking about AI learns from data points, right? So if the data points that it has is people tend to sell when the market goes down,
wouldn't it just do that?
Wouldn't it just do that? And it would just be the exact same thing that if you were to just had a normal investor invest for themselves.
Yeah.
In theory, hopefully they wouldn't do that. They would adopt it from another source, but I don't know.
All right. Now I'm scared again.
I don't know. It's one of those situations where I personally, at this stage of the game, wouldn't trust AI to run my own money. But, robo advisors have been around for a very, very long time now.
They've been underperforming.
Nothing new. And they've been underperforming for a very long time because they're just.
Well, they're programmed by, and now we're getting in the weeds, but they're programmed by modern investment theory.
They are.
And that hasn't been a great theory for a long time.
No, it hasn't.
Until as of late, right?
Yeah.
But anyways, I think thinking about the stock market as a collection of data points and thinking about AI as a collection of data points is a fair comparison. And I think if that helps you understand what we're referring to when we're referring to the market, that's fine. But it's also important to remember it's not rogue, right?
Yeah, there are some very, very key differences between the two, versus, and it's just kind of like what we talked about, having an isolated unit, over here, whether it's ChatGPT or Claude, that's trying to basically predict something. That's not what the market's trying to do. The market over here is trying to maximize profit. And there's a bunch of different sources out there that are trying to do that differently.
Yeah.
And, like we just talked about, as one source becomes very profitable, it immediately homogenizes and it loses its edge. But, it's efficient until it's not.
Efficient until it's not. I like that. That's my favorite takeaway.
Cool.
All right. Cool.
Thanks.
Thanks, Colin.
Let's wrap it up. Thanks, Wheeler. Subscribe,
yes.
Share with a friend.
Exactly.
Thank you.
The information in this material is for general information only and is not intended to provide specific advice or recommendations for any individual. Investment advice offered through Integrated Partners, doing business as Ko-Fi Advisors LLC, a registered investment advisor. Integrated Partners does not provide legal, tax, mortgage advice or services. Please consult your legal tax advisor regarding your specific situation. Past performance is no guarantee of future results. All investing involves risk, including loss of principal. No strategy assures success or protects against loss. The economic forecasts set forth in this material may not develop as predicted, and there can be no guarantee that the strategies promoted will be successful.
Compound Growth with Wheeler and Colin. Sponsored by Ko-Fi Advisors. Reach out today. Yay!